Today's the day that the US finally raises its interest rates. Or is it? Chief economist from MNI Indicators is on the line. So Philip, how are you expecting the markets to trade in the run-up to the announcement?
Well, I think markets are pretty much fully pricing in a hike of 25 basis points from the Fed. Fed fund futures are putting the chances at about 80% of a hike. So I don't think we're going to see any big moves ahead of the decision. I mean, there's only a few hours to go now. I mean, over the last few days, we've seen equities trending a little bit lower. In the bond market, we've seen yields across the curve move a little bit higher in recent days, and that's as expectations have hardened further. But I think markets now, they're going to really hold fire to see whether rates are raised. And maybe more importantly than that is whether the accompanying commentary in the statement and from Fed Chair Yellen and what that says.
Okay, so would you include yourself in the 80% that expect the Fed to raise rates? And perhaps more importantly, what would this mean for the markets?
Yeah, we're looking for the Fed to increase the target range by 25 basis points to 0.25 to 0.5%. So that's bang on the market median. I think more important, though, as I said, it's really the commentary, and this will really set the tone for markets. So overall, sitting alongside the rate hike, I'd expect to see a relatively dovish statement from the Fed today. And the real question to me is whether the Fed can make it dovish enough to please markets that are really only pricing in just over 2 25 basis point rate hikes in 2016. And I mean, my expectation is that even if the FOMC members, use the dot plot that they publish every quarter to revise lower their rate expectations for next year and maybe the year out, interest rate markets are going to really find it difficult not to head lower. And we'll probably likely see the dollar strengthen further after the meeting as well. I really just can't see how the Fed will be dovish enough for markets while also providing an upbeat tone to attempt to increase the wider public's belief that the economy is clearly on the mend.
Right, and lastly, depending on the decision, the US could revisit the interest rates early next year to then raise again. So how do you assess the performance of the US economy as we move into a new calendar year?
Yeah, I mean, certainly markets are going to be scouring the statement, the dot plot, the commentary today for clues as to when the next hike will be. My guess is we'll see more aggressive action than most expect next year, and I think we'll see the Fed likely to look to raising rates again at the March meeting. I mean, our general view on the economy is there's quite a lot of underlying strength there. Employment growth remains firm, unemployment's at a very low level. There's also some tentative signs of wage growth coming through as well, although I would emphasize they are only tentative at the moment. But elsewhere, consumer confidence is firm, housing markets made a good recovery, and while the industrial side of the economy, has not been in quite such good shape, it's struggling with a strong dollar, it's struggling with oil prices as well, I think the Fed's going to look at the economy as a whole. And while inflation at the headline level is very low, core inflation at around 2% against a backdrop of a tightening labor market, then I think it's important for the Fed to be forward-looking. And I think that's something that will be stressed today by Yellen in the press conference.
Thank you, Philip. We'll have to wait and see for now, but be sure to check back with Dukascopy TV for more updates. See you next time.